Yesterday on Twitter, I'd asked a question, what is your biggest trading issue? And the options to it were, number 1, lack of conviction, number 2, bad psychology, number 3, bad execution, or number 4, all of them. And I was surprised to see that many people actually voted for the fourth option, all of them. So I decided to make a detailed video explaining how to counter all these issues, and so here I am. So in this video, we are going to understand these issues one by one. We are going to go through these issues one by one, understand the root cause behind what's giving them so much power and authority over you, and finally learn the ways to counter them. So if you are someone who is struggling to make your way out of markets, this video is a must watch for you. So enough of the talk, now let's get to the business. Hey guys, welcome back to the channel. This is Shrish here from Trading Explained, and now without any further ado, let's begin. So let's start the video with the first issue, and that is lack of conviction. So what exactly is this issue? What exactly does lack of conviction means? So let me give you an example. Let's say you have taken a trade and the trade has just started to go in your favor. But now you're panicking. You're trying to trail your stop loss to reduce the risk. You're trying to exit out of the trade because you think the trade might reverse against you at any given time. And before even your target gets hit, you are out of the trade. You exited the trade. And then you see 10 minutes later, your target actually gets hit. Now this happened because you did not had enough conviction in the trade. Now what basically conviction means? According to Google, conviction basically means a firmly held belief or an opinion. Now how are you going to believe in that trade if you are not confident enough yourself? So basically, lack of conviction is coming from lack of confidence. Can you agree on that one? Yes. So lack of conviction is basically nothing but lack of confidence. And why is there a lack of confidence? Well, basically lack of confidence comes from lack of practice, right? So if you practice something over and over and over again, you get confident about that particular thing. But if you haven't practiced it enough, you are not confident about that thing. And this thing applies to trading as well. If you haven't practiced charts enough, then you won't get the confidence and the conviction to hold on to any particular trade or any other cases. There are so many cases where conviction is needed. Like in this example we saw, you needed conviction to hold on to your trade until the target is met. There can be other cases as well. Like let's say the trade is going against you. You have placed a stop loss, but before the stop loss is getting taken out, you are getting out of the trade because you feel the stop loss is definitely going to get hit, and before even the stop loss actually got hit, you are out of the trade. What happens? The moment you get out, market reverses back from that very moment and takes your target. Now, did it take your stop loss? No. It was coming down just to make you panic. Now, you need to understand that conviction is needed in cases like this. Like you need to hold your trade with that stop loss and targets in place, even if it is doing or making you panic. Like that is basically what the trading thing is, not letting your emotions come into the game. So number 1, lack of conviction. Where is it coming from? It is coming from lack of confidence. And how can you gain confidence? Well, you can gain confidence by doing a lot of practice. Open charts, see where you could have done better, see what your mistakes were and try to improve on those things. And when you do that over and over and over again, you basically do a lot of practice, and practice will give you a lot of confidence to trade live markets, and confidence will give you conviction. So if you are not having any conviction in yourself, in your trades or in your setup, it basically means that you haven't practiced that thing enough. So practice will give you confidence, and confidence will give you conviction. Let's now head to the second issue, and that is bad psychology. Now there are many things that actually contribute to this issue because psychology is such a vast subject that it actually doesn't end very easily. But when we talk about psychology of trading, there are a couple of important things that we need to focus on, and I'm going to point out those to you. So number 1 is wrong expectations from market. Having expectations of making unrealistic returns is probably the most common habit amongst retailers. They expect their money to grow 10x, 20x, 50x, 100x within a short amount of time. And these wrong expectations lead to bad psychology, because then you are not thinking about making a business, you are basically thinking about gambling in the market. Any business, be it any business, no business can grow like 10x, 20x, 50x, 100x within 2 months, 3 months, 6 months, or 1 year. You pick any business and you will see that it requires significant amount of time and effort to grow that business to a scale, and that is exactly same with the markets as well. So wrong expectations from the market is probably the number one reason which disrupts your psychology, and then the cycle goes on and on and on, and you are trapped and you do not know what to know, and then the cycle continues. So number one, wrong expectations from market. Number two is lack of concentration. Today we live in a world where almost every person is addicted to cheap dopamine shots. We open our phone, watch some videos, we get dopamine, we keep our phone back. 10 minutes later, we feel the need of dopamine again, we open our phone, check some shorts, Instagrams, and keep it back. 10 minutes later, we feel it again, we open our phone, play some games, keep it back. And this cycle of cheap dopamine shots is basically killing our attention span, is basically killing our concentration. And if you do not have focus and concentration in any aspect of life, then it is going to be extremely difficult for you to make it in that particular field. I have seen many people who, while trading, take out their phone, check YouTube videos while the markets are on, while they're analyzing the markets, and all of a sudden they just completely lose their concentration, they lose what they were tracking, what they were analyzing, and for no reason they're lost in their mobile phones. I used to do this thing as well, and the moment I realized that this is not the correct way of going into any business, I tried to correct myself. So lack of concentration, lack of attention span is another reason which disrupts our psychology, because when you see, psychology is something which really needs concentration as a base of it. Like if you are concentrated on something, only then your psychology or understanding about the subject will get better. And if you are not concentrated, if your attention is not, or if your focus is not on the subject where you need to improve, it is impossible to grow in that particular aspect. So lack of concentration. So what you can do, try to limit the use of your phone while trading markets. Just keep it aside, keep it on do not disturb mode, put it on silent. Don't care about who is messaging you, who is calling you, because if you are trading markets and if you get disturbed every now and then, you're not going to have that concentration. And you know who your enemies are while trading markets? They are those hedge fund managers, those billion-dollar hedge fund managers who have been into markets since like 20-30 years and know every bit of how market operates, and you are trying to survive against them. So you will have no chance if you are not concentrated. So number two, lack of concentration, that is the biggest issue that contributes to the bad psychology. And number three is, I feel, lack of probabilitical thinking. What does this mean? Well, probabilitical thinking basically means understanding and completely accepting the fact that the outcome of any trade is going to be random. But as a retailers, what we do, we expect profits out of every trade that we punch. The moment we punch, we do not think about the risk, but we think about all the possible money that can be made. And that is where problem begins, because everyone is doing the same thing. Pretty much every retailer is thinking the same way. If I could cash these 20 points, I will be able to make 500 rupees. If I am able to hold this trade for 200 points, I'll be able to make 10,000 rupees and whatnot. But what you should be doing instead is doing the exactly opposite of it, doing the risk analysis, understanding how much you're going to lose. That is more important. So if you analyze and understand that this is the amount of risk that I am taking on this trade and I am completely fine losing that thing, then it will completely change your psychology about trading markets. Because until and unless you take that risk factor into consideration, until and unless you completely accept the risk, it is going to be impossible for you to be consistently profitable, because you're not thinking about the risk, you're thinking about the profits. And trust me, if you think about the profits, consistent profitability is going to be just a dream. So what you can do, think in probabilities. First, accept the risk, completely accept the risk and understand what you are risking, and focus on the risk part, not on the reward part. If you are focused on keeping those losses small, keeping your risk small, then the rewards will take care of themselves. So stop thinking about profits the moment you enter into a trade. Rather than that, start thinking about the risk that you're taking and try to completely accept that risk. That is the only way to actually think in a probabilitical way, and that probably is the only way to come out profitable out of markets. Let's now head to the third and last issue, and that is bad execution. What is bad execution? Well, bad execution basically means understanding and knowing what needs to be done, but still not doing it. It is mainly the fear that plays a big role when we talk about bad execution, either the fear of being wrong or the fear of losing money. So, to get rid of bad execution, we need to get rid of our fear. I had read this book called Trading in the Zone by Mark Douglas, and in that book there was one paragraph which defined risk in such a good way that I really felt the need to put it out over here. Mark Douglas says, when it comes to trading, your fears will act against you in such a way that they will cause the very thing you are afraid of to actually happen. If you are afraid of being wrong, your fear will act upon your perception of market information in a way that will cause you to do something that ends up making you wrong. Fear is immobilizing. Physically, it causes us to freeze or run. Mentally, it causes us to narrow our focus of attention to the object of our fear. This means that thoughts about other possibilities as well as other information from the market get blocked. This is such a good definition of fear that if you understand what Mark is trying to say at this point, I guess you don't even need to watch another video about how to trade markets. Because what is bad execution? Bad execution, as I told you, is basically knowing and understanding what needs to be done, but we are still not doing it. We're still not pulling the trigger. For example, you see your trade is there, you see your setup is properly aligning with the markets and the market is telling you to buy, but your fingers are locked. You're not able to pull the trigger, you're not able to punch that buy button. The setup is there, everything is screaming into your face to buy markets, but for some reason you're not doing it. You're not having conviction, you're not having confidence, you are having fear, I don't know, you're not doing it. And 5 minutes later, or perhaps 5 seconds later, you see the market proves you right. The breakout that you were trying to buy actually breaks out and just whoop goes up 1 or 2% in the next 5-10 seconds, and then you regret why I did not took this trade. I should have taken this trade, why I didn't. And then you try to enter into that trade and then everything starts to go wrong because your entry was not after the breakout but instead before it. So this causes many problems. The execution thing is probably the worst thing that a trader can have. You need to have your execution skills right, because knowing is one thing, understanding is another thing, and then executing those things in actual live market is something that not everyone can achieve. And that is probably the reason why so many people are analysts, working as analysts in companies, and they become analysts. But there's a huge difference between an analyst and a trader, because analysts do not know how to trade, they only know how to analyze charts. They are good analysts, they know what is going to happen, but they cannot trade it in live markets. And to differentiate yourself from being an analyst and trader, you need to learn that skill of execution, because until and unless you execute, it is going to be of no use. All your knowledge, understanding about markets, everything, it's just going to be a waste. So how to execute? As Mark Douglas says in his book, it's about the fear. So get rid of your fear. There's nothing to fear about the fear actually, because if you see, our fears are basically of those things which do not even exist. For example, fear of losing money. Question number 1, have you lost the money? No. Then why are you fearing about losing money? Because it has not happened yet. It is based on your past experiences. But if you try to live your life based on your past experiences, then it is going to be difficult. Yes, you can take help of them, but at least in trading, it is going to be a lot difficult if you rely on your past experiences. Okay, you need to punch those trades when your setups are there. You need to execute your skills, you need to execute your knowledge. because mostly our fears are based on something which does not even exist yet, and that is why those fears are just in our mind. The moment you capture your mind, those fears will be gone. So try to capture your fears, and once you do that, you'll be able to execute in markets in a much better way. So I hope this video was helpful to you. I hope you learned something out of this video. Probably a lengthier video than you would have liked, but not many people are going to watch until this part. So if you're watching, congratulations, because as I said, the attention span of humans is getting very short, and not many people are going to watch this video until this part. So if you are really until here, hats off to you. You're really hungry for the knowledge, and if you keep the same approach, you might even make it. So yes, if you like this video, make sure to smash the like button, subscribe to the channel, because I keep coming back with such videos that revolve around trading, trading psychology, trading success, trading consistency. Everything that you need to know about trading, you will find on this channel. So make sure to subscribe and check my other videos as well, because there's a lot of content I have made on trading that will help you become a better trader. I will see you in the next one. Until then, you guys take care. Bye bye. Peace out.